Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Matt, the lumberjack landlord. How you doing, buddy?
I'm doing super good. Excited for segment number 3.
Yeah, so you wanted to talk to me about something I mentioned yesterday, folks. I did a daily financial news every day. So if you want to look it up, it's Daily Financial News, October 3rd, and then just a bunch of words. But you can look up October 3rd, where I spent the first 5 minutes talking about this topic. Matt, you watched it. You wanted to ask me some questions. So let's dive in and go just a little bit deeper.
I do. So one of the things that I think is unique about how we have our conversations is that we can't be parental and just say, because I said so.
Yeah.
We actually have to back it up with math. So what I wanted to talk to you about was, as we all know, my call is 10 to 20% before the year 2025. I think the market corrects from the highs. That's what I think. Yep. And so I know that you've been in the camp for a long time, and I want to know if you're still in that camp, because I'm not sure I feel comfortable with more people jumping on my bandwagon, but I mean, I guess I don't really have a choice because I only have 4,000 subscribers. As much as I love them all and they're near and dear to me, I'm not moving needles. Yeah. And so what do you think? Like, what do you think about that? Is that giving you any consternation about potentially losing the dollar?
Yeah, I'm not worried about a buck. That hasn't changed.
You say that now, but
yeah. When you have it behind you on the wall, it says Michael's dollar. That'll annoy me. But I got to tell you, I mean, Lance Lambert, somebody who's an editor for Fortune, somebody who's been on my channel and likely will be again. He wrote a great article, and the number of people jumping on your bandwagon off of mine is frightening. Not only the quantity, but the velocity, right? The number of, I almost said cowards. That's not right. The number of people switching their opinions in the last 30 days is pretty phenomenal. And to be clear, they're a little bit even more negative than you, right? Your bet is by December 31st, 2024, there will be a cumulative 10 to 20%. You're giving yourself that extra year.
Yeah.
The people that Lance is talking about, -5 to -15 next year. And again, I want to remind you that the worst year we ever saw in the last 52 was during the Great Recession, was -8.9. Right. These are national median numbers. Any one market could fall 20%, no problem. But we are talking national median, as are they. So it is absolutely apples to apples.
Yes.
So the first thing I think about when I read this, and I read it a couple of times, is I think we have some echo chamber, some group think going on. A lot of analysts that are public nature like this they're more comfortable being wrong together than right standalone. They have comfort being together. And I've never had that. I have no problem being wrong. I admit it when it happens. I use the opportunity to learn, like, what did I miss? So I have no problem. If I'm the last person standing on an island that says real estate's going to go 0% in price the next 3 to 5 years, I'm okay with that. It's just what I believe. But as I peel back their opinions, we're talking Mark Zandi and CoreLogics and Goldman Sachs and just, on and on and on. There's a couple of things where I'm actually more bearish than they are, which is really odd.
Okay.
So the first thing I notice is the largest transaction decline they're calling is 30%.
Yeah.
And I'm like, dude, we're already there.
Right.
We're going to 50% next year.
Yep.
So the first thing, and the reason that I feel good. I don't feel as great as I did, but I certainly feel good about my call, is the denominator of the number we're talking about, it's just going to be much, much smaller, right? If you told me we're going to do 7 million transactions in 2023, so we did 6.7 2021, we'll probably do, let's call it 5 million in 2022 this year. And then if you told me we went back to 7 million next year, I would say you and they are absolutely right. The only way we go up from 5 to 7 million next year is we have waves of foreclosures. We have waves of forced sellers. Unemployment goes to 10. Bad shit happens.
Mhm.
If we do 7 million transactions next year, I'm wrong. Period.
Mhm.
I happen to believe we're not going to do 5 million. We're going to do 4 or below. Like four, I think my current number is 4.2
I agree.
or below.
Yep. I think it's 4
So the
below.
first, yeah. So in my world, if we do 4.2 or below in 2023, my call of flat still has a chance.
Mhm.
One. So again, I'm giving you things where people can just track my performance.
Sure.
So that is number one thing I believe. Number two, rates got to 7% faster than you and I expected. And a lot of these people have extrapolated the rate and speed of 7%. And thus we're going to 8, we're going to 9.
And
I
10,
do not, yeah, I
yeah,
do not
yeah,
believe any of that.
I agree. I agree.
I believe we will, we've hit 7. We've likely backed off it. We may hit 7 again. But I believe when you average rates for 2023, they will be sub 6. Now, to be clear, I'm talking owner rock, 20% down, best credit. Again, you can track this and tell me, and everybody will know if I am wrong where I was wrong. So again, I called 7%. I didn't call 7% rates in September. I called them in November, December, but we are here now.
Mhm.
I do not extrapolate 8 and 9. Again, you can, if I'm wrong, everybody will know. But
Mhm.
again, investor loans are already there. So again, owner rocks. Number 3, I know consumers. And what will happen is if rates go where I expect them to, again, let's talk 5.99, for example. That's 30-year fixed, best credit, best at this, that. We are going to see a continued uptick in ARMs, which will get people in the 4s.
Mhm.
And what they will do is they will play the rate betting game.
Mhm.
5, 7, 10 years, rates will come down. I don't
Mhm.
recommend that, but nobody listens to me. So people will do it in mass.
Mhm.
Right. All of a sudden, next year, we got people buying houses with 4s on them.
Mhm.
We get loans in the 4s again. People are going to go batshit crazy.
Mhm.
Right. So
Yep.
that's number 3. Number 4, and the biggest kind of anchor of my belief is we have already experienced record demand destruction. I believe we are about to experience record supply destruction. And this is probably the one that people can watch the fastest. I believe September inventory will be below August, active listings, October below September, November below October. So I believe we will just see trailing inventory. And yes, I admit demand destruction is crazy. But if you take record supply destruction and the base number, I mean, even when rates were 20%, transactions still happen, right? There's still cash buyers. There are still people have bags full of money leaving California, going places. You're going to still have some transactions. So, I think that happens. Number 5, I believe if we get to high unemployment, say 7% or above, we will get what banks learned, that extend and pretend works. What do I mean by that? Well, the Great Recession was built on the backs of banks foreclosing. What did not happen the last 2 years? Foreclosures. Less than 1% of transactions are distressed. So I think banks will just, 6 months forgiveness, or not forgiveness, forbearance. Here you go. No problem. 40-year mortgage, blah, 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 blah. So when we have an economic pain, which I do see coming, and I see it being housing led, I
Mhm.
don't see banks foreclosing in mass because they realize, hey, that worked out pretty well. We're going to do that again. Number 6, and this is my anchor for why I think housing is flat for 5 years, is I think we have 5 years of wage growth. I think the years of the CEOs getting all the goodies is over, much like the 1970s. I think wages will grow above trend. They will eventually grow on real, not nominal. It just takes time, right? One of the ways to cure all of this unaffordability is to raise wages. So I think that is coming. And then finally, the biggest bugaboo that I don't think a lot of people are looking at is first-time homebuyer programs. I think we've started to see them. I think they're going to come out in mass. I think banks are going to just do it, right? Because again, banks live on loans.
Mhm.
Banks don't buy treasuries, right? You and I go put $1 million in a bank. They're not going to go buy $1 million in treasury. No, they're going to take that $1 million. They're going to lever it out 8 or 9 to 1 because that's where they make the spread. This is called fractional reserve banks.
Mhm.
So when banks don't get loans because there's only 4 million transactions or 4.2, they're going to get hyper creative. And let's all be clear, first time home buyers aren't the best negotiators. They'll gladly pay whatever the payment works. So those are all the reasons I am not changing my opinion. I am not a housing bull. That's one thing I want people to be. People call me a housing bull. I am not. I'm actually a bigger bear because I think there's a housing depression. But the housing depression is on transactions, not price. Price elasticity or inelasticity in a home is much worse. It is exacerbated by supply lock-in or interest rate lock-in. So again, those are my thoughts. That's why I'm calling flat. And just to be clear, where I'm calling flat, -1, -1 to +1, right? That's what I give myself. And that is on national median home price by the end of next year. So what do you think of all that?
I think you're wrong.
Ah, awesome.
No, I think you make a great case for a lot of things. I think for me, ninth grade dropout, I make it really simple for myself, which is the really, the move up buyer gone because of rates, the expensive home buyer for the $3, $4, $5, $7 million house, not when their portfolio's down 30%.
Yeah.
They're not buying because they're looking at their RSUs and they're looking at their actual stock portfolio to buy that next house. And so I think that there's a decent amount of activity. I think it's on the lower end, but I think that there's only so much lower end that can carry you because a $500,000 or $700,000 house isn't a lower end house, and that's what's being built right now. What's really funny is I talked to a couple of guys that I know that own a pretty massive sheetrock company, and they said it's as busy as it's ever been.
Interesting.
And I said, how is that? And he goes, so he starts walking me through it. And I said, I know what's happened. I said, they basically had all their plans approved in May.
Now
April and May. They can't sell something unfinished. So I said, you're going to start to see stuff in 2023. Those orders, those are going to start to slow down because, and he's like, Matt, they're just selling, they're buying stuff like crazy. I said, right. But the money stops coming in when they start not being able to sell a house at 7.5%. And even if they buy it down to 6%, it's still a problem. I said, so that part, builders are only worth as much as what their last development sold through. I said, if they're not getting that sell through, then that's going to be their problem. It's going to stop them because then when they go to get money, or even when they go to deploy their own, they have investors, and the investors are going to look at it and go, not so ambitious. We need to roll it back a little bit, and I talked to one yesterday. He said, they're a smaller developer. They have, I think it's 3 houses on the market. And he said, when one of those sells, he's like, we still have 2 foundations that we've poured, and one of those sells, we'll start that one up again. That wasn't the case 6 months ago, right? Yeah. It was like, we poured it, now framing, and boom, 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 we're done. I did ask him too. I said, what was your typical time frame for completing those projects? He said, we used to be able to do a home in about 120 days. And he goes, now they run about 160, 165. People don't consider that that's 25%. Yeah. That's a lot of days. That's a lot of days. So when you're looking at that and the carry costs and everything else, it's more expensive. But yeah, the guys that I've talked to, a couple of really good business guys, I admire them a lot. They're really smart guys. They've said it's been as busy as it's ever been, but I think it's because they're working their way through the book. I think they're working their way through the book of business the builders have, because they've already paid and have 30 homes or 40 homes or 50 homes that were stick built. They gotta sheetrock them so they can sell them, because they can't do anything when they're just sticks. Yeah. So,
oh man, 2023 is gonna be an interesting year. And again, you have more and more people coming to your side, so you might need a bigger bandwagon.
They can subscribe.
They can subscribe. Well, do me a favor. Where would somebody go to subscribe to see everything you do? And you have a landlord, I don't know what you call it, product review that you do that's just second to none. So I love those.
I appreciate that. Yeah. So DIY Cost Seg was the most recent one. Loved working with those guys. They saved me an absolute ton of money on my taxes because we did a cost segregation, and the way that they do it is 100% online, and it takes about 10 minutes to do it. So nice. Inexpensive. Yeah. So it's been fantastic. But yeah, Lumberjack Landlord is where you find me. And that video is there posted with DIY Cost Seg. Thanks, Mike.
Awesome. Thanks, buddy.